All right, well, I'm seeing top of the hour and we've got a good crowd here, so let's go ahead and kick things off. Welcome to today's Don't Be Scared of Long-Term Care Impact Day, put on by NAIFA's Limited and Extended Care Planning Center. I'm also joined by the center's executive director, Carol Golden. She is here as well, and we are very excited for this day that actually kicks off Long-Term Care Month. We know it's a day early, but we thought we would just have a little scare themed presentations for everyone. And we are going to start things off with one of my personal favorites, Harlan Accola. And the presentation is Homes Are Not Mysterious Hideaways, They're Assets. And Harlan is the National Reverse Mortgage Director of Fairway Mortgage. And without further ado, I will turn things over to him. Harlan, welcome.
Thank you, Zach. Really appreciate it. And, you know, I don't think I want to start out with two stories here. The first one is not really a story, but more a comment about the election year, or the election final weeks leading up to the election. Very hotly contested, all of the top concerns that everybody is talking about and what voters are most concerned about. Do you know that long-term care doesn't even make the top 10? It should, because there's going to be about 70 million of us in 10, 15 years. And how many of us are going to need care? If the statistics are there, it's about half. And so that's 20, 30, 40 million people. I don't know how many are going to need care. Where are the people to take care of them? Where's the facilities? Where's the government involvement? We can't really count on the government because they're off chasing all kinds of different ideas, Republican or Democrat, I don't care which one. Sometimes they don't have our best interests at heart. And it's pretty darn frustrating because I don't think there's anything quite as important as this issue in taking a look at the next 20 years. I've listened to Joe Jordan a number of times on his presentations, and he talks about the aging problem nationwide. And that this is the biggest single concern that people are not paying attention to. And as advisors, we can't wait around for the government or for some sort of other, somebody else to take care of it. We have to do what we can do one person at a time. The second story that I want to mention before I bring up a couple of slides, and then the majority of this, I want to be a Q&A. And so get your questions ready from that perspective. But the second scenario is I was in Las Vegas at Ed Slott's elite advisor group that I had just spoken at, and I was driving to the airport with an Uber guy, and the phone rang. And so he was going to click it off. And I said, "Hey, that's Mom. You better answer that phone call," because I could see his screen. And so he answered and he said, "Hi, Mom, I'm working right now." And she said, "Well, son, I will get off the phone then. I didn't know you were working." And I said, No, Mom, you don't get to talk to your son very much, I bet. Just stay on. I'm just sitting here in the back seat doing emails. Don't worry about it. And she said, "Well, you sound like a nice man." She said, "Where are you from?" And I started talking with Mom. And she said, "Well, what are you in Las Vegas for? Are you goofing off?" And I said, "No, I'm working. I'm teaching people about reverse mortgages." And she said, "I'm 81 years old and you're never going to catch me getting one of those. Those things are awful." I said, Mom, no, it's not like that. And I said, "What you need to understand is that this is actually a benefit to you. And by the way, do you have a long-term care plan?" Was the next question out of my mouth. "Well, my son will take care of me." And he turns around and looks at me and like, "Me?" He's an Uber driver and he's got his own responsibilities. And we talked for a little bit more. And I said, "I tell you what, Mom, I'm going to give you a book and I want you to read that book. And then I'm going to talk to you just a week or so after you get home," because she was off on vacation and that's why she was calling her son. Hung up the phone. And the son said, "I'm not going to give Mom this book." I said, "Really, why?" And he said, "Because you're messing with my inheritance. I don't like what you're doing. You're going to steal Mom's house. And my sister and I want that house." And I said, "Do you have a place to live?" And he said, "Yeah, but Mom's house is worth a lot of money and we're going to sell it when she passes away. She's 81 after all." And I said, "Well, just a second. How do you know you're going to get the house?" And he said, "Well, it's only my sister and I know that we're in the will. I'm pretty sure we are." And I said, "Well, that's probably true. But what happens if your mom has a long-term care event and she burns up all of the equity in the house, all of it, and you and your sister get nothing because she has a long-term care problem and early onset Alzheimer's, you already said, is kind of an issue. And what happens then?" And he said, well, we haven't really had thought much about that. And I said, well, you should. Probably can't qualify for long-term care insurance right now, but at least the house could be used for it. I said, that's what my dad used it for when he had a stroke when he was 86. So after we got done, he said, well, I'm going to read that book before I even give it to mom. I'm 58. I can do one of these in 4 years. I said, exactly. So the issue is he doesn't have long-term care insurance, and he realized that he could purchase long-term care if he didn't keep making his mortgage payments, because there's all kinds of people like that just keep making mortgage payments when they don't have to. And then they don't buy some of the other things that they should buy as they head, such as life insurance, annuities, and long-term care, as they head into one of the most unpredictable, scariest times of life. Now, the title of our program today is Don't Be Scared of Long-Term Care. I think you should be scared of long-term care. You shouldn't be scared of long-term care planning. Maybe we should have added one word on that, because this is something that is a real fear. He should be afraid. That Uber driver should be afraid of what happens to his mom and her needs if she needs long-term care. Perhaps I'm the best poster child to kick this off today, because my mom and dad used a reverse mortgage and their line of credit in the reverse mortgage to pay for their care when dad had a stroke at 86, as I just mentioned, and mom had Alzheimer's. Dad was the primary caregiver. All of a sudden, they went from not needing any money out of the reverse mortgage or out of anything other than Social Security, because they lived frugally and carefully and they had a great life. But all of a sudden, they needed $8,000 a month. Now, this was 10 years ago. It'd probably be $10,000, $15,000 a month now for home care. Let's think about that for a minute. What happens? Where does that money come from if all of a sudden on one night, when I got the call that my dad had a stroke and he was on the way to the hospital at 2:00 in the morning, everything changed that night? And even though I know a lot about this stuff, and my dad did not get long-term care when he could have got long-term care because he had a stupid son who thought that long-term care was not a good idea. That was me. I was stupid about stuff. I didn't understand it. And he had the opportunity to buy long-term care when he's in his 50s. I said, Dad, you got 4 kids. Well, I'll take care of you. Yeah, they're all scattered all over, and I'm the closest one, 30 miles away, and I've got 4 kids under the age of 10. Really? That's going to work then? So under the age of, actually, they were a little bit older, under the age of 18. So the issue is, what we have to realize is there is a direct connection between housing wealth and the long-term care problem in this country. There's 11 trillion with a T, $11 trillion sitting in seniors' equity over the age of people over the age of 62, 11 trillion. What if that was deposited into life insurance policies with long-term care riders? What if that was used to pay for long-term care policies that were lapsing? What if it was used for annuities that had long-term care provisions? Instead of sending that money to pay off a house, what would change from that? What would dramatically change? That is a huge issue, and is something that way too many people don't realize and don't understand. Now, to just share a quick graphic, this is something that we often show, and that is a Swiss Army knife. You can see paying for healthcare expenses and paying for long-term care are two of the tools that people way too often do not use and are not aware of that they are available. And so reverse mortgages are often looked at as, well, that's for people that are broke. That's for people that didn't plan well. That's for people that were just a little bit stupid. And I saw an article once that said, if you're old, broke, and stupid, maybe a reverse mortgage is a good idea. Old, broke, and stupid. Really? I'm old, but I'm not broke and I'm not stupid, and I have a reverse mortgage. And I have a life insurance policy with long-term care riders, and I have annuities. So I'm prepared for retirement. But most of the people that we run into are not. And why not? Why are they not? Because that's for somebody else. There was an interesting story of the number of people that did not have flood insurance when the hurricane hit in Florida. Very painful situation. And they said, well, there's less than a 3% chance that a hurricane would hit, so it doesn't make any sense to pay that much for insurance. Well, there's about a 50% chance, as all of you know, that long-term care will hit. So why don't we use one of the reverse mortgage tools? Because after all, we pour money into a reverse mortgage. Why can't we just take it out of there? In fact, I will show you another graphic here. I'm not going to go through 60 slides, so don't get nervous here because we're going to have some time for questions. Whoops, I hit the wrong button. And that was not the button to hit here. So it's this little graphic right here. Okay, so everybody has 3 buckets of wealth that own a house, that are in retirement. Even people that aren't in retirement. So think about this for a minute. You've got bucket 1, which is your client's bucket, their ability to make money, their ability to get Social Security, their ability to get a pension, whatever. Then you've got bucket 2, that's your bucket. That's a bucket that you use to put in annuities and life insurance and stocks, bonds, mutual funds, savings accounts, whatever. Money that is not needed today that can be used in the future. Then you've got bucket 3 over here, which is the bucket that my team at Fairway works on every day, and anybody that owns a house, helping people build up home equity, help them buy a house, help them refinance a house, help them improve a house, whatever. And if you take a look at this pre-retirement wallet, let's think about how the distribution of money works. You make a bunch of money during 18 to 62 years old, and you put it up here into your wallet, and most of it evaporates right off the top, and you spend it on something called the cost of living. I saw a sign outside a church a long time ago, and it said the cost of living is high, but it's still extremely popular. That is something that is really appropriate for today with inflation. The cost of living is high, but it's still extremely popular. We still fill up our cars with gas. We still go to the grocery store and buy food, even though the price is high. So, however, any money that we don't use, we give to our financial advisor, and we dump it into 401ks, IRAs, stocks, bonds, life insurance, annuities, whatever. And that all drops down here into bucket 2, into the middle bucket. But what a lot of people don't realize is about 29% of our income, statistically, as of 2021, 29% of our income goes into house payments, into bucket 3, 29%. You might only give 5% to your financial advisor. Some wealthy people give 10 or 20%. But most people don't save a third of their income. But a third of somebody's income comes into us, a third, almost a third, 29%. That's a tremendous amount of cash flow. But why do we put money into bucket 3 or bucket 2? We put it in there so we've got money for the future. We put money into Social Security that gets deducted from our wages so we can take it out. So when we get to the post-retirement wallet here on the bottom, and we're after 62 or 67 or whenever we retire, then we start pulling money out of Social Security because we put it in when we were younger. And we take money out of our life insurance, or we take money out of our annuities. We turn the annuities on, or we take money out of our IRAs. However, very seldom do people take money out of bucket 3. In fact, 44% of people are still putting money into bucket 3 after they turn 62. To the detriment of the money that we put into bucket 2. People are putting so much money into bucket 3 that they cannot put enough money into bucket 2. This is not something that is my opinion. This is an absolute statement. We have a bunch of people, millions of people, that have virtually nothing in bucket 2, very little nest egg. You meet some of them. Maybe they've got 10,000, 20,000, 50,000, 100,000, and that's all they have when they reach 62. About 50% of people have virtually nothing in savings by the time they hit 62. But many of them, more than half, have their house paid off. So there's $11 trillion sitting in home equity. Why are we not looking at this twofold? Why aren't we looking at putting less money into bucket 3, not trying to pay off the house, because we get a reverse mortgage at 62 and we take our payment to 0 anyway, and then putting more money into our life insurance, our long-term care, our annuities that are going to give us income in retirement and protect us. There's a whole bunch of people that can't afford long-term care insurance because they're too busy paying off their house. They took a 15-year mortgage out, and they're making extra payments. Ran into a guy that's making double payments on a 15-year mortgage that is below 2%. Really? And he doesn't have long-term care, he doesn't have life insurance, and he doesn't have any annuities at all. But he's going to pay off his house if it kills him. And it might. So the issue is that when we take a look at this whole distribution, as financial advisors, we need to be educating people. There's nothing wrong with putting money into a house, but don't put too much money into bucket 3, because I'm going to make a very profound statement right now that you might even want to write down. The more money you put into bucket 3, the less money people have to put into bucket 2. And you say, well, Harlan, that's kind of simple and basic. We're advanced financial advisors. Well, that's not simple and basic because most people put too much money into bucket three and they got a paid off house, but they don't have anything to speak of in bucket two. We know that 95% of people do not have a reverse mortgage and 95% of people do not have long-term care insurance. Is there a connection there? Because when I started in the business, we could give people a discount on their closing costs on the government mortgage insurance if they bought long-term care at the same time, long-term care insurance at the same time that they bought the reverse mortgage. Unfortunately, the government changed that because they said, wow, that'll just make the insurance companies rich, which no, it would actually help the clients and protect the clients. But that's long past. That's not available anymore. But do we encourage, even though we don't sell long-term care insurance, life insurance, annuities, at Fairway, we don't sell any other products. We strictly sell mortgages. But we work with people like you across the country, and NAIFA is our back-end wealth management division, where we refer business to you, all of our hundreds of loan officers, to be able to refer business so that people can put more money into bucket two and less money into bucket three. Because there's two different types of scenarios. There's people in a younger than 62. Those that are putting too much money into bucket three and not putting money into bucket two, 30-year-olds, 40-year-olds, 50-year-olds that are trying to pay off their house and dumping hundreds of thousands of dollars into bucket three. And then they don't have life insurance, long-term care insurance. They don't have any annuities to guarantee income in the future. They're just too busy paying off their house. Then the second group of people are the people, and most of those people can qualify for long-term care, and they could afford it if they didn't try so hard to pay off their house. Let's look at the second group of people. Those are the people that are over 62. Many of them can qualify for long-term care yet. They're still healthy enough. I'm 62 and I'm healthy enough. I just did my updated one of my policies last year. And so a lot of people can still qualify. It's a little bit late, but a lot of people can still qualify in their 60s. And then it might be more expensive, but then they haven't paid for a long period of time. And my payment, when I did my reverse mortgage at 62 in April, my payment went to zero, which allows me to put more money into bucket two. It allows me to dump more money into life, annuity, and long-term care benefits in long-term in bucket two, because I did not pay off my house and my mortgage payment went to zero. There's three different types of people who are over 62. The first group of people are the people like me that have a mortgage payment when you reach 62, either by design or like mine, or by accident, you're still making a mortgage payment. Those people should, if they have 50, 60% equity, should stop making a mortgage payment so that they have more money that they can put into bucket two, or so they take less money out of bucket two, especially with the market being down right now. The second group of people are the people that have their houses paid off. Maybe they can't even afford long-term care anymore, or they can't qualify for long-term care, but they can at least set that up like my dad did, so that when he reached 86, he could pull that $8,000 a month out of bucket three because he did not have insurance. And that enabled him to be able to stay in his house for a longer period of time with home care. The third group of people are people that you meet every day. And those are people that are in the wrong house. They're in a house with stairs. They're in a house that needs a lot of repairs. They're in a house that is a long ways from the hospital. They're not in a house that is designed to age in place. They don't have wide doors. They have too much carpet and rugs that they can trip on and stairs that they can fall down and so on and so forth. That is something that causes long-term care problems. And the quicker that we can counsel those people to get out of that house and into a newer house, into a house closer to medical facilities and maybe closer to their children, their grandchildren, and so on, the better it is. And you may say, well, yeah, but they can't afford it. They've got their other house paid off. I moved to a more expensive area when I sold my house, but I was able to afford that more expensive house because I only had to put about 50, 60% down, and the rest of it was paid for with the reverse mortgage. So reverse mortgages figure into a lot of situations. Now, three quick things before we kind of open things up for questions. The first thing is, are you now factoring in the $11 trillion sitting in bucket three? Are you factoring that into your planning with your clients? Are you looking at that just like you look and you review their life insurance policies, you review their annuities, you review the money that they've got in their IRAs and their 401ks? Are you also reviewing how much equity they have in the house, whether or not they're sending money to bucket three? or whether they're not, whether, excuse me, whether they're thinking about canceling their long-term care policy because it got too expensive, or they're not planning on putting that into the life insurance with later in the day. We've got someone that's talking about the living benefits at 3:00. Ramona is going to talk about the living benefits review. Are they buying products in bucket 2 that will ensure that they don't have to worry and they don't have to be scared of what happens when long-term care hits down the road? That is the biggest question that I have for you today. Are you factoring that into the plan? Or are you only looking at their 401ks and their IRAs? And are you only looking at bucket 2 and ignoring bucket 3, the largest asset class in the history of the country? Largest asset class in the history of the country. $11 trillion. In fact, it's the largest asset class in the history of any country in the world that has been amassed into one bucket, the bucket of home equity, which is worthless until it is used. Now, a lot of you are saying, yeah, but Harlan, you're messing. You started out this conversation threatening that poor Uber driver with stealing an inheritance from him and his sister. So what about the kids? What about the kids? Let's talk about the kids. My son just blessed us with well, my son didn't, his wife did, our beautiful daughter-in-law blessed us with our third grandchild from their family. And we have 2 other ones, a new little boy that was born on Thursday named Henry Thomas Accola. And he's just a really cool little kid. I'll show you some pictures if we have time. No, but anyway, they've got a 4-year-old, a little daughter, Lauren, and a 2-year-old, Piper. And now they have a little baby, a newborn baby. Now we're trying to help them. If one of us had long-term care needs, are they going to be in the position to help us? Both of them have jobs. She's in a 12-week maternity leave, but both of them have demanding jobs. She's a physical therapist. He's a commercial lender at US Bank. Has to do some traveling. Are they going to be in the position to take care of mom and dad? Not even close. They've got very big responsibilities of their own. And then my other son with twin kids that are 5, also very demanding jobs. 2 of our sons don't have kids yet, but probably will. So when all of a sudden I turn 70 and 80, should I assume that they're supposed to take care of me or my wife? Does that really make sense? No, that's not a good legacy to leave. That's a burden to them. That's a problem financially. It's a problem with time. It could wreck their career. It could put them in a situation where they would quite frankly be a bit resentful of what happened. It's my job to plan and not be a burden to the next generation. That's number one with the kids. Will that mean that they will get a little less money coming out of bucket 3? Yeah, because I'm spending equity in bucket 3. But I put more money into bucket 2, and my kids will probably be better off because I got life insurance, and they're going to get a big life insurance check from my wife or I when we pass away. There's probably going to be money left in the other areas because we have long-term care insurance, and we have planned for that ever since that happened with my dad 10, 15 years ago. So it's very, very important to understand that if you want to leave a legacy for your kids, the first thing you should be concerned about is not leaving them a house, but not leaving them with care. So the idea that I'm going to give my house to my kids really doesn't make sense because number one, the kids don't want it. They're going to sell it. They want the money inside the house, but they're going to sell it. Well, when I pass away and my wife passes away, there will be less equity in bucket 3 because we will have used that money to spend on them while they're alive. We'll have used that money to protect us against the long-term care problem. We'll have used that money to put in things like life insurance that will leave a legacy that we plan for them. And quite frankly, it'll give us ability to spend more time with them because I don't have to continue to work to try to put too much money into bucket 3. So they're protected. And you say, well, yeah, but Harlan, just a minute. What happens if this housing crash happens and you owe more on the house when you die? So great, you haven't been a long-term care problem to them, but now your house is upside down at the end. Well, for those of you that aren't familiar, reverse mortgages are insured by the Federal Housing Administration. And if I owe more on my house when I die, the kids aren't responsible for it. My estate's not responsible for it. My life insurance isn't responsible for it. FHA mortgage insurance is going to pay that difference because I paid that mortgage insurance when I closed on my loan way back. I gave up some equity to pay for that, which everybody says, oh, that's expensive. Well, long-term care insurance is expensive. Life insurance is expensive compared to what? So in this situation, and that's really where I want to have a little bit of a dialogue and hear from you, is in this situation, and I've worked with some of the absolute top people in the industry, Dr. Barry Sachs, Dr. Wade Pfau, Texas Tech University, the folks at Boston College, the folks at the American College, Jamie Hopkins. And quite frankly, Jamie Hopkins is the most vocal. Jamie Hopkins, who developed the RACP program with Dr. Wade Pfau, said, hey, just like people got sued for not offering long-term care insurance, advisors are going to get sued for not talking about the $11 trillion sitting over here in bucket 3. Really a significant issue, super important. And so there are so many people that completely ignore this in their planning, don't even look at it, and they concentrate on the return on investment in stocks, or what's going to happen with your income, or when should you draw Social Security. All very important things. But the biggest single thing that can uproot all of those and just turn the tables on all of those great intentions is whether or not I'm going to need long-term care at the rate of $10,000, $12,000, $15,000 a month, or memory care when I'm no longer able to take care of myself. And that is something that if it is not in the planning and you don't incorporate the $11 trillion that's sitting in bucket 3, it's amazing. And when you think about it, between us in the mortgage industry and you in the financial services industry, if we properly use the products that we have at our disposal and we work together on helping clients, we can wipe out the long-term care problem in this country, because we're sitting at $11 trillion. And then people are dumping it in at a much greater rate. When I started in the business, there was $4 trillion in bucket 3 20 years ago. Now there's 11 trillion. People, I guess I failed. People didn't listen to me. I mean, they're still putting more money into bucket 3 than they are into bucket 2. That's crazy. And we got to change that. And we can only do that by working together. So I certainly want to leave some time open to hear from all of you and some comments, some questions of just a minute. Why are we not putting this first place in our planning? How many of you are using this to make sure that this is a part of your overall plan? And how many of your clients, I would say that the measure of your success should be this: how many of your clients are protected against a long-term care problem that happens tomorrow, like the call I got from my dad a number of years ago when he was on his way to the hospital and was in the hospital for 6 months with the mom that had Alzheimer's at home. Are your clients prepared for that? Because even if you know what's going on in the industry like I did, it's devastating. It is dramatic. It is fast. You don't have time to plan for it. Boom, it just happened. And everything changed for our family that night. Okay, I will stop for a second. And Anne just finished the RACP program, really practical and applicable. That is awesome. The RACP program that Pfau and Hopkins put together, I think, is one of the best for financial planners because it focuses on coming down the mountain. That's what Wade Pfau talks about, is there's more people that die coming down Mount Everest than going up Mount Everest. You'd think it'd be more dangerous going up. Using our money after we turn 62 or 67 or 70 or whatever in retirement is one of the most dangerous and most unpredictable times in our life.
Harlan, first of all, thank you so much, not only for being here, but for your presentation as well. I just want to let everyone know you can unmute yourselves. That is available to you. And there's also a raise hand feature. So if you would like to raise your hand, we can call on you for a question and we can get the ball rolling here.
Can you please go over, Gabriella said MBA and an RACP, cool. Can you please go over objections and how to answer them? First of all, I'm pretty good at selling life insurance, even though I've never, made any commission on life insurance applications or anything else. But I'm really good at explaining to people why they should buy life insurance instead of paying off their house. However, when it comes to objections on life insurance, I simply open the idea of life insurance annuities and tell them that they should talk to somebody about life products. And that is something that is important for me to stay in my lane. What you should do is be working with a reverse mortgage loan officer that clearly understands the process. We have a 5-step process, and we're working with financial advisors of how to work with you together so that we can present it correctly to financial advisors. And we go through we go through this 5-step process, and we don't talk to the client until step 4. So the first thing is you don't bring up reverse mortgages, because if we had a seminar, I'm doing a seminar with for you guys later this month with Caleb Williams about the 3 most important products that can ensure a better retirement. And that, if we had a seminar on long-term care, life insurance, and reverse mortgages, not very many people would show up. So if you lead with the fact that you should buy this or you should buy that, that will not work. I guarantee you, because all you got to do is remember the Uber driver? All I had to do is utter the words reverse mortgage and was immediately negative to both him and his 81-year-old mom. So you don't lead with that. You simply say, if we take a look at all of your assets, would you be okay with us putting a plan together of how best to use all of your assets, including your home, to make sure that we can use your home to stay at home, or that to make sure that you are never in a position to lose that. So there's only 3 major objections on a reverse mortgage. One is cost, and you deal with cost all the time. You give up 2% of your equity in the case of a reverse mortgage. The second scenario is I'm going to hurt the kids because they're going to lose equity. They're going to lose cash if they don't lose equity. And the third scenario is that I understand that I'm going to lose my house, or my wife is going to get kicked out of the house when I die. None of those things are true, so you can fight those things back with facts. But Gabriella, I will tell you that the most effective way to sell long-term care, life insurance, reverse mortgages, or any of the unpopular products is simply to have a plan of how this goes and what it looks like at the end. How do we put this together so if this happens, this happens, this happens, where you're going to be at. And if any of you have any specific objections that bothers you about reverse mortgage, because 90% of people would be better off with a reverse mortgage. That's fact. That's not me talking. That's Dr. Wade Pfau, Jamie Hopkins, all the other people. So the bottom line is that, you're going to be looking at a situation where most people are going to be better off. And this isn't an advertisement for Fairway, so I will just direct you to, we're a sponsor of Fairway. I'm going to Michigan later this week. We do a lot of local scenarios with NAIFA across the country. Just let me know if you have some questions about how we can sponsor any of your events, especially during long-term care month. We're really big on working together with that. Skip, you mentioned about the Cinderella story. A lot of people have used my book. My book is not anything about Fairway. It's strictly about reverse mortgages. It's kind of a fun story because Cinderella wasn't invited to the ball. And if some of you want a copy of it, just contact me and I'll make sure that I help you out with, that's got a lot of the basics. And some people just give my book, like I work with Jim Silbernagel, which many of you know. He just got a stack of my books in his office and he just hands them out and says, I want you to read this and tell me what you think about it. And so that's one way to handle it. Carol has an awesome book on long-term care and has a chapter on it in reverse mortgages. Sometimes a third party giving that information will be of help to you on that. So, and I tried to write it from fun. Like one of the chapters is drug, sex, and reverse mortgages, and one of it is about the stepsisters, and just putting in different things so that, because let's face it, a lot of the stuff we talk about is boring to the average person, even though we think it's exciting. So I just tried to make it as interesting as possible, and it's short. It'll take you less than 3 hours to read it. It's only 90 pages. Okay, Scott Roche, how does the rise in interest rates affect the reverse mortgage? Most of it is good as compared to forward mortgages. The bottom line with interest rates is they drop. The higher the interest rate, the lower the loan to value. Interest rate controls the loan to value. Some mortgage products are where you get 80% LTV or 90% LTV or whatever. On a reverse mortgage, the amount of money that's available to you goes down when the interest rates go up. So if you're eligible for 50% last year because the interest rates were low, You might only be eligible for 40% of your value if interest rates are higher, like right now. So if you have a $600,000 house and you could get $300,000 in available line of credit to use for potential care, well, now that's down to about somewhere in the neighborhood of 240 instead of 300. So you lost about $60,000 of available amount of money. But the good thing is your line of credit goes up faster. So if rates are 6%, for example, then the amount of money that's available to you continues to go up, which is a really good reason why you should, which Fau talks about in his book, why you should get a reverse mortgage at 62 when you don't need it. Because when's the best time to borrow money? When you don't need it. I mean, everybody knows the answer to that. You borrow money when you don't need it. That's the easiest time to get it. Well, you put your line of credit in place for potential issues and problems in the future, so it's available. If you don't need it, that's great. At least you had it there just in case. It's like insurance money, so to speak, that money is available if you need help in making payments on your premium payments on long-term care, or just taking care of things after you lose a spouse, or whatever the situation is. So that's how the rise in interest rates affects the reverse mortgage, is you end up with a little bit less cash to be available from there, but more on the other side of the equation. So that is really more so a plus than a negative. On the forward mortgages, it's a negative because payments go up. On a reverse mortgage, your payments are always zero. And the larger the interest rate, the faster your available line of credit goes up. Okay, any other specific questions? Don said great info for dues paying member. We believe in NAIFA. We're a national sponsor, and we have well over 100 of our loan officers that are also, I think we're the largest non-financial planning type group that has the most members. And so we believe in the mission that you have, and we've got to get it out. We've got to protect it, with the Washington, DC thing coming up. Our own employee, Cheryl Cancinella, is going to be there, which many of you know. That's the other scenario from there. Dan said, I've got a client with concerns about qualifying for a reverse mortgage. Well, the quicker you do a reverse mortgage, the more likely you are to qualify, because when you start getting late on payments and everything else, there could be an issue. But it's much easier, much easier to qualify for a reverse mortgage than a forward mortgage. So if there's questions, just send me an email, and I'll let you know what. I do not sell reverse mortgages anymore myself personally. I'm not a licensed loan officer anymore. I was for 20 years, but I'll certainly give you an idea of what can be done. So I'll just put my email if you have any specific questions that are not for the overall group. And How Not to Tear Your Family Apart is Carol's book. You can go on to Amazon, and there's a book for you and a book for consumers that's coming out next month. That's something that is a super. I bought the book right away, or maybe Carol gave it to me, but I think I bought it. But anyway, I've got a couple copies of it, and it's written in a great story form, where people are going through dealing with a long-term care situation. And if you want to tear your family apart, just don't make a plan for long-term care and then deal with it when it comes up. That's a great way to tear your family apart. So make some plans beforehand. Don't leave your kids with that kind of problem to deal with. George said, once you take out the reverse mortgage, does the debt only begin accruing when you tap the line of credit? Yes. And let's be careful about the word debt. It is money that you owe, but it's not money that you have to pay while you're alive. It's due a year after you're dead, or whenever you move out of the house, and the house is responsible for it. So it's not your debt. That's really the difference from there. So super important to be aware of how that works and how that fits together. By the way, one of the big advantages with a loan officer like our team, we train our people. A lot of our loan officers are on this call. We train them on what you do, even though they can't do it, so that they understand the other side. The only way we're going to solve this problem is our two industries working together. That's why we're a big sponsor of NAIFA, because we have to have the mortgage industry, the housing industry working together with you on the other side of the equation. Very critical scenario from there. Okay, so we obviously talked about Carol's book. And finishing George's scenario. If I have a reverse mortgage, I will die with less equity, but I will have more money available while I'm alive, and I will probably leave my kids with more net worth in the other products like life insurance. So when I die, my kids are going to get my house and whatever equity is left, but they're also going to get a life insurance check within a month after I'm dead or my wife is dead, with no tax implications. I think that's a better legacy. The stuff that you sell in bucket 2 is more valuable than a housing scenario in bucket 3. How do you even know what the house is worth when you die? So will I lose that? Yes, I will. There isn't any question about that. But on the other side of the equation, what happens? In fact, I often show this to my clients. And let me pull this out here. How many of you have ever seen a tombstone like this? Joe or Jane, homeowner, born in 1945, died 2035, paid off home, $348,000 home equity at death. I've got a perfect record on this. I've shown this to thousands of people. I don't think any of you have seen it. If you did, that breaks my perfect record. But tens of thousands of people have seen this slide, and nobody has ever seen a tombstone like this, ever, or a plaque on a casket or a sign at a funeral. I mean, the goal is to live life well. I just saw a tombstone over the weekend, and it said, "To a life well lived." Didn't say anything about how much home equity he had. Now, you can get a smile out of this when you show this to people, but why do so many people live like this is the goal? You don't hear people on their deathbed saying, "I'm so glad I got a bunch of equity in my house." I mean, that isn't the goal. They're glad if they weren't a burden to their kids. They're glad if they helped others. But that is the situation that is so incredibly important to be aware of that. Scott Roshi said, reverse mortgage kept my parents in their home 15 years longer than would have been possible otherwise. There you go. Now they have less equity, but they were able to live in their home 15 years longer. I mean, how do you weigh that out? How do you put a price on that? Thank you for that. That's an excellent point. One of the direct messages was, why is 62 the right age? Because that's as soon as you can get it. That's when you become eligible. Because back in 1988, when they came up with reverse mortgages, they said, here's the day. Here's the age. 62 is when you can do this. And that is the magic age of being, and I did mine, and I turned 62 on April 26th. On the morning of April 27th, I was signing my papers. So would waiting longer be detrimental? I don't know if detrimental is the right word, but it's definitely not as good of an advantage. I've never had anybody that I've done mortgages for, which I've done for 20 years, and I no longer do personally, but now through all the folks at Fairway, I've never had anybody that said, I wished I wouldn't have got a reverse mortgage, but there's a bunch of people that said, I wished I would have got it earlier. So
hello, Lori, can you hear me?
Go ahead.
Okay, great. This is Jim Miller, Utilities Credit Union in Pennsylvania. How are you today?
Okay, Jim, I don't think Jim is talking to me. Okay, somebody else. Okay, so in that situation, when you take a look at the delay, that means you have to put more money into bucket 3, so you've got less money in bucket 2. So even if you don't need it, you should immediately start building that line of credit so that you've got money available later in life. You should immediately stop making your mortgage payment, because the mortgage payment doesn't make sense to pay into that, because you're not trying to die with the most equity on the tombstone. So the issue is, why? Why would you continue to do that when you don't have to? What's the reason for paying down your house? Well, because I still got money. Just because you got money doesn't mean that you should do it, because if you're not totally prepared for long-term care, which we know that 95% of people haven't, even if you don't qualify, at least you should put this in place so you've got some money sitting there in case you need that in the future. So there's no good reason to wait. We've done a lot of research on that. Your industry has done a lot of research on that, Fowle, Hopkins, and of course, Barry Sachs. And there's no good reason to wait. You're not going to accomplish more by waiting. That isn't where it's going to be, well, we got through that. That's like waiting to buy insurance and then the hurricane hits. Well, then it's too late. So we need to be reminding every one of our clients, because there's so many people that are scared to death. With Halloween, our theme, they're scared to death of losing equity. They should be scared to death of what long-term care is going to cost them. That's way worse. Because how do you, if you ask anybody, are you prepared for $120,000 a year in care if you need memory care? Are you prepared for that? I mean, that's a very basic question. If you haven't asked all of your clients that question, then are you concerned with them the way that you should be? Because that is the single biggest worry that anybody should have. And there's so many people that are worried about the stock market, and they're worried about whether or not the cost of life insurance is too much, or what's the expense load on an annuity. It's more than a mutual fund, and I don't want to lose equity. They should be scared of what's going on with how fast things can be depleted, and to Carol's book, how quickly your family can be torn apart. What is the cost of that? Do you want to be on your deathbed? Do you want to be a burden to your family and have them fighting because they can't take care of you, or one of them can and the other one can't? And make sure you're asking your clients. As Mazzella said, some clients think their Social Security checks will take care of your long-term care. Not even close. Some people think Medicare will pay for long-term care. I'm sure you've had a lot of clients that said, yeah, Medicare takes care of that. Medicare will take care of my nursing home. And of course, Medicaid kicks in when you're broke. So, I don't want to tell you how to do your business, but I'm going to be very bold that I'm so thankful, and I'm kind of preaching to the choir here. And that is that, this 9 to 5 long-term care scenario, you guys are all listening, and you guys are all paying attention. And those of you that are listening to this recording are paying attention to this, but there's 25,000 members in NAIFA. I mean, how come most of them aren't on? I mean, this is the most important issue that's facing our generation in the next 20, 30, 40 years. And we have to be very concerned about that. Okay, last couple of questions. Winnie said they're taking the chance, think it's too late to buy long-term care, too expensive. Yeah, it's just like a reverse mortgage. People say, I'll wait until I need it. You don't wait until the car's smoking on the side of the road before you change the oil. You do pre-planning. I mean, that's basic. We know that you do pre-planning and maintenance before that stuff happens, not when it happens. There wasn't any time for planning after my dad had his stroke that night. You get a call at 2 a.m. and you woke up knowing that your life has changed forever. That's not the time for planning. You don't have the plan in place. Well, now it's going to be chaos. Ekta Perek said, can you qualify for a reverse mortgage if you're paying a mortgage? Yeah, I was paying a mortgage, just eliminated the mortgage payment so I could put more money in the bucket too. So I have more protection and more legacy. So there's 2 types of people. Remember, there's the people that have their mortgage paid off, and there's people that don't have their mortgage paid off. I was somebody that didn't have the mortgage paid off, so I used the reverse mortgage to pay off the forward mortgage, and now my payment is 0. So I can put more money into bucket 2, and I have less money going into bucket 3. That's really the difference. So whether you're currently have a mortgage or you don't have a mortgage, either one will work, just in different ways. The Swiss Army knife is just a different tool. Okay. Oh, hey. Craig had a quick question. Do you recommend a line of credit to pay down and draw, or a fixed rate loan? 99% of the time, I will recommend a line of credit, because I don't care how much equity I die with. I care how much cash that I have available. And so we can kind of go into some details. There's a few people that it makes sense on a fixed rate loan. Most of the time, the line of credit is the one that makes the most sense. Thank you for all of your questions. And again, if you have anything that you have specific questions on, my email's in the chat box. Just send it to harlan@fairwaymc.com. And we will, if you have any NAIFA events that you want to help us sponsor, or work together with even training people in your office, that's what I do. That's what my job is working with NAIFA and doing that together.
Well, on behalf of NAIFA, on behalf of everyone who has joined the call, I want to thank you, Harlan. It's always a pleasure Plus, I always learn something every time I hear you speak. Harlan is easily one of the biggest supporters of NAIFA, particularly also of the Limited and Extended Care Planning Center. This is, of course, an issue that most of us have misconceptions about. So I encourage you to contact Harlan. He will put you in touch with education, with people who can really make you comfortable. I have to say, I'm in one of those areas where I have paid off my house and I am now looking at what can I do to save my children from having to pitch in at all. As Harlan said, we don't want to be caught in the sandwich generation. And that's pretty much what we're looking at. There are 4 generations now in the workplace. And who's going to be the one that you're going to yank out and have it influence their retirement funding, the other 2 buckets that Harlan referred to. So on behalf of everyone who has attended, myself, NAIFA, the LECP Center, Harlan, thank you. This was wonderful. And I would just remind everyone, this is a recording. So if you want to go back and listen to it again, which I will do, we will make it available to you. Okay, our next session will start at the top of the hour at 10 a.m. and we hope to give you a short break. Thank you.